Good afternoon, everyone. Thanks for attending today's Super 101 webinar. We'll just give everyone a few moments to join the webinar and we'll commence shortly. Perfect. So we'll kick off today's webinar. So my name is Chet Cayley and I'm a member account specialist with Brighter Super. An important part of my role is guiding our valued members towards a comfortable retirement. By the end of today's webinar, we aim to give you some useful information on the basics of superannuation. So before we go ahead, Brighter Super acknowledges the traditional owners of the lands on which we are meeting and pay our respects to their elders, past, present, and emerging. We acknowledge and celebrate the continuation of a living culture that has a unique role in this region. So before we start, it's important to understand that the information and examples contained in the presentation are general in nature and have been prepared without taking into account your individual objectives, financial situation, or needs. It is important when making decisions about your super options that you obtain the relevant product disclosure statement and target market determination and consider your own personal circumstances. You can access these documents and the Financial Services Guide from the Brighter Super website. Today's presentation will run for about 30 minutes. Many of you have submitted questions already, which we have tried to incorporate into the presentation. You can also post questions in the Q&A feature during our presentation today, which we will aim to answer directly. Today, we have James Town standing by as a moderator today. James has been with the fund for about 6 years. He is regularly out in the field providing super health checks to members in different regions across Queensland.
Hi. I'm going to just be sitting in the background today, so please, if there are any questions, please add them in the chat and I'll answer them as we go along.
Perfect, thanks James. So we should have time for questions at the end and we will try to answer as many as possible. We will also be running some poll questions throughout today's presentation. When the question pops up on your screen, please just click an answer that is appropriate to you. Also, don't worry about taking too many notes today. We will send you the recording in the coming days. So before we move on to our main subject, I would like to take this opportunity to briefly explain who we are, as we may have some non-members online with us today. So a bit of who is Brighter Super. So the merger between LGIA Super and Energy Super, plus the acquisition of Suncorp Super, has enabled us to increase our size and scale. Yet we remain committed to investing in the personalised member services that you know and enjoy. We manage over 250,000 members with over 30 billion in funds under management. Our My Super option was ranked top 5 funds in the peer super ratings for financial year 2023. So now let's talk superannuation. The purpose of superannuation is to preserve savings to deliver income for a dignified retirement, alongside government support in an equitable and sustainable way. Now, most of us make our contributions every year, but we don't really think about how much we really need until we come to age 50. And now we think, oh my word, I haven't looked at it. So let's explain what superannuation is and how it works. Super is linked to your employment. Your employer contributes money into an account on your behalf. Your money is then invested. Any fees and insurance premiums are deducted, and what remains is your benefit. Superannuation is important now, as it takes a long time to save up enough money to retire on. Making good decisions early is essential. There are benefits of contributing extra to your super. The money your employer is putting into your super for you is a great start, but by adding a little bit more, you can make a huge difference to your retirement balance. And now is just the time to start thinking about your super, even if it does feel like a long way off. So, there are benefits of contributing extra into your super. The money your employer is putting into your super for you is a great start. But by adding a bit more, you can make a huge difference to your retirement balance. And now is the time to start to think about your super, even if it does feel like a long way off. Compounding returns makes a difference. You don't need to add a lot to see a big difference. By contributing an extra $20 a week over 40 years, your balance could be $132,000. If you add an extra $50 a week over 40 years, your balance could be over $330,000. This is assuming a 5% compounded annually, a 5% return compounded annually before fees and costs. So as you can see here, using our previous example of $20 a week until the age of 60, let's take a moment to look how different this could be if you started this extra contributions earlier or later in life. You can see by starting earlier, you have more time to benefit from compound returns on your superannuation savings. Imagine the difference that $125,000 would make to your retirement compared to $13,000. There are some important points to consider before deciding whether to add extra funds into your super. With all contribution types, there are contribution caps to be mindful of. We'll cover these caps in detail later in the presentation. Depending on your level of income, some types of contributions may be more or less tax effective, so you should carefully consider which is right for you. You should review your budget to ensure you can support the reduction in take-home pay. Also, any additional contributions you make form part of your preserved amount, which you cannot access until you meet a condition of release, which is generally retirement. So now that we know what superannuation is and the potential benefits of increased contributions, we need to talk about the ways to put money in. There are two types of super contributions: concessional, or some people may refer to it as before tax, or non-concessional, which you can refer to it as after tax. The concessional limit, the concessional contribution limit for the current financial year is $27,500. Concessional contributions are made from pre-tax money and include your employee contributions, any salary sacrifice, whether that's mandatory or voluntary, and any tax-deductible personal contributions. If you exceed the cap, excess contributions are taxed at your marginal tax rate. Non-concessional contributions comes from money that you have already paid tax on. As a result, these contributions are made after tax and no further tax is deducted. Under current rules, you can potentially contribute up to $110,000 per financial year. Under the age of 75, you can also bring forward up to $330,000, depending on your total super balance. There are other considerations, so please consider seeking advice. Later in this presentation, we will discuss how we can help you with this. So what are the ways you can contribute? What are the ways to contribute money to super? It depends on your overall taxable income. So Australia has a tiered personal taxation system, which means we all get taxed at a progressively higher rate the more we earn. If you're earning between $45,001 and $120,000, your overall marginal tax rate will be 32.5% plus the Medicare levy of 2% if applicable. If you're earning over $120,000, your tax rate may be even higher. So let's apply this to super contributions. An after-tax contribution simply means that the income tax has already been deducted from the money before it's contributed into super. There's no tax on entry to the funds and forms a tax-free component within super. More on that later. If your employer allows you to salary sacrifice or you claim a tax deduction on your after-tax contributions, the contributions are taxed at a rate of 15%. For those of you earning between $45,000 and $120,000, generally this means you'll be paying less tax on your before tax super contributions. So what is the best way to contribute? It depends on your personal circumstances, and you should seek further advice as to what works best for yourself. So before we move to an example, let's ask our first poll question. So, do you salary sacrifice? Lovely. So that's interesting. It's about there's about 60% of you that salary sacrifice and about 40% that don't. So, it's as I mentioned, it's definitely something worth having a chat to us about, or potentially looking at advice. But definitely food for thought for those who want. Okay. Because it could be beneficial for you. So let's assume this member is contributing 5,000 to their super, and they earn between 45,000 to 100 and 120,000. If they make an after-tax contribution, the tax paid would be $1,725. If their employer allows them to salary sacrifice or they claim a tax deduction, they would be saving about $975 per year based on the difference in tax rates. That's extra money in your pocket. It's up to you what you do with this money. You may have immediate financial commitments or looking towards the future. It can potentially be a great way to boost your retirement savings. Remember, it's all about lifestyle. Introducing Sally, a hypothetical Brother Super member. Her situation may have similarities to yours, but we have not considered anyone's personal circumstances in this scenario. Sally has recently turned 40 and is in a position to make extra contributions to her super. She's looking at putting an extra $5,000 per year into her super via salary sacrifice. The cost of salary sacrifice, meaning the reduction in take-home pay, is just over $60 a week. If Sally doesn't add money to her super account, she will have a balance of $295,244 at age 45. If she contributes $5,000 into a super account via salary sacrifice, she will have a balance of $320,289 at age 45, which would have saved herself $4,594 in tax over 5 years. That's money in your pocket at the same time as saving more for your retirement. Then, if Sally decides to add her tax savings into super via salary sacrifice as well, she'd have a balance of at 45 of $333,478. Based on assumptions and considering her circumstances, Sally has saved money in tax, boosted her super balance by contributing to super. The assumptions include future legislated super guarantee increases, 2.5% wage growth per year, 2.5% inflation, and investment returns of 5.5%. For the full list of assumptions, please refer to the slide disclaimer on the screen when you're receiving the recording in the coming days. But the main thing is, as you can see, small changes over a period can make a big difference. At Brighter Super, we are here to help. Our website contains a range of resources, including a salary sacrifice calculator. It allows you to find out how much you can maximize your super by contributing before and or after tax. You can find this and other calculators under our resources tab, and it takes about 10 minutes to complete. It also gives you the option to see if you could afford to contribute more by reducing your take-home pay. Remember that small changes today can make a big difference in the future. Let's discuss another type of contribution in more detail. This was one of our pre-submitted questions for today's webinar, the carry forward contribution. A person may be able to access any unused concessional cap from previous years based on several criteria. It came into effect in the 2019-2020 financial year, and eligible members may have up to 5 years to use any unused concessional amounts. So, for example, if a member has unused concessional amounts accrued in the 2019-2020 financial year, the last year they are able to contribute towards those amounts is the financial year 2024-2025. So for starters, to be eligible, you must have a super balance under 500,000 at the start of the financial year in which a contribution is made. So remember, concessional contributions may include salary sacrifice or tax deductible contributions. You can track your concessional contributions through MyGov. This could help if a member has taken time out of the workforce. It could be an opportunity to get back on track for retirement. Remember, any money put into super is generally only available once you reach retirement age. For this strategy, we recommend seeking advice to ensure that this is right for you. And there are also other ways in which you are able to get extra money into your super. So, depending on your personal circumstances, there are other contribution options available. In addition to the previously discussed carry forward contribution, these include spouse contribution, bring forward, downsizer, government co-contribution, and the low income tax offset. Like anything else, rules and eligibility criteria apply. So for more information, please visit our website or alternatively reach out to us. So investments. Once you have the money in super, then you then want it to grow. So it will sustain you throughout your retirement. We do this by investing it. The reason why investing produces a return is because there's risk involved. If you give someone $1 and expect them to give you $1.20 back next year, there is a risk involved that you won't get your money back. This is the key to investing, is understanding risk. Brighter Super aims to grow our members' super balances while providing consistent returns. This means we want your investment to grow when markets are performing strongly and reduce the impact when markets start to fall. We place great value on diversification, which means not having all your eggs in one basket. To achieve this, we offer ready-made investment options which spreads your money across a number of different asset classes to reduce the level of risk. Each of our ready-made investment options offer the benefits of our strategically chosen investments. Depending on what stage of your working life you're at, what your retirement goals are, and how long you've got before you retire, you may want to take more or less risk. And we have options for you. So we're going to talk a bit about this over the next few slides. So some people think of their super as a single asset, but it can potentially be invested in many different assets. Most super funds offer different types of investment choices to their members. Investment choice is selecting which asset classes you're invested in, such as Australian shares, international shares, fixed interest, cash, or property. Investment options offered by super funds could either be diversified, so that's investing in a mix of different asset classes, or single sector options, which is investing on just one asset class. Diversification can be achieved by choosing a ready-made diversified option, such as growth or balanced investment option, or by choosing a mix of single sector options, choosing your own mix of different asset classes rather than a ready-made mix. So our next poll question is, do you know which investment option you are all in? I'll just give you guys all a moment to answer that. Lovely. So I can see about 70% of you are aware of what you're in, which is brilliant, and about 30% don't. So, that's really a great time to check in. And even for those which are aware of what investment option you're in, it still may be worth revisiting and just checking if it's still appropriate for yourself. So assets such as equity, otherwise known as shares, are described as growth assets. These may see volatility over the short term. The value may go up and down, but over longer time periods, they generally experience higher growth. Asset classes such like cash and fixed interest are sometimes described as defensive options. These carry less risk in terms of volatility of returns and potential for capital loss. They also offer less potential for high returns. These options are generally described as low risk / low return. Ready-made diversified options are made up of different mixes of growth and defensive assets. Often when I'm talking to people about investment choice, I'm asked the question, what is the best way to invest my super? And as you could probably imagine, there is not one single investment option or profile that would be fit for everyone. In fact, there are a number of different things to consider when choosing the right risk profile for you. So what is a risk profile, you may ask? A risk profile is an individual measure of how you feel about risk and return, keeping in mind that there is always a trade-off between these two. It takes into account your tolerance to market falls, as well as your investment timeframe and desired return outcomes. In a perfect world, we would all love high returns without taking falls. However, generally speaking, the more risk you take, the better return you should expect in the long term. However, the greater chance of bigger swings, including negative returns in the short term. So, for example, an aggressive investment is expected to generate a higher rate of return over the long term. However, it is likely to fluctuate more in value. What this means is that your investments may grow faster over time. However, it'll generally lose more when the market dips and produce more frequent negative return years. Whereas a more conservative investment, on the other hand, is likely to have fewer negative return years overall and may not drop as far as an aggressive investment during a downturn. However, the trade-off for less downside risk is that the positive returns are expected to be lower over the long term. Understanding your risk profile and your investment risks is important to help better prepare for market movements and make informed decisions. Being invested outside of your risk profile is a risk itself. If you're invested too conservatively, that may be missing out on potential returns that you could have. If you invest too aggressively, you may see greater falls during market instability than you are comfortable with. Both of these scenarios do not result in an optimal outcome, so it is important that you know where you sit. You can find the investment risk profiler on our website page under resources. If you'd like to learn more about investing in super, we recommend you registering for one of our webinars called Investment Basics, and a new date for this will be added on our website in the coming weeks. So to insurance. Often, a tax-efficient way to take out death insurance, total and permanent disability insurance, and income protection is through your super. These are very important insurances as they take care of your loved ones. As they ensure that your loved ones are taken care of if you can no longer take care of them. Apologies. Your employer's super contributions and salary sacrifice contributions are taxed at 15%. This is lower than your marginal tax rate for most people. This can make paying for insurance through super tax effective. It is important to only insure what you need and the right level of cover so you're not paying more premiums than necessary. So there are three types of insurance that you can include within your super: death, total and permanent disability, and income protection. So death cover provides your loved ones with a lump sum if you were to pass away. Total and permanent disability pays you a lump sum if you suffer total and permanent disability. Income protection pays you an income if you're injured or otherwise unable to work. Life insurance pays your loved ones if you pass away or become terminally ill. This means they don't have to worry about money during what will already be a very tough time. These are important insurances, but you need to make sure you have the right cover. So, a bit on beneficiaries. So your superannuation benefit is an asset that is not included as part of your estate. This means you may wish to consider giving your super fund instructions as to who your money goes to in the event of your passing. Super funds can generally only pay to a dependent under superannuation law. So that's a spouse, child or children, financial dependent, or someone who is in an interdependent relationship. There is a preferred nomination, a guide to how you'd like your benefit distributed to in the event of your death. This can be completed or updated online in the member online portal. Preferred nominations are not binding on Brighter Super, and as such, While we take your wishes into account, we will also identify all your defendants and pay your benefit according to the rules set out in the LGIA Super Trust deed. On the other hand, there is a binding nomination, which legally binds superannuation to pay your death benefit to your nominated beneficiary or beneficiaries. It must be completed in writing, and beneficiaries must be a dependent or a legal personal representative, and valid at the time of your passing. A binding nomination is valid for a maximum of 3 years, and we will notify you prior to its expiry. You've also got the option of a non-lapsing binding beneficiary, which does not require your nomination to be renewed every 3 years, and may be an option if you do not wish to complete ongoing nominations. It is important to review this regularly to ensure that your nomination remains valid and continues to reflect your wishes. It's also a reversionary nomination, which is for pension accounts only. Nomination of a reversionary beneficiary will allow the pension account to continue to be paid and directly to your eligible beneficiary, which is generally a spouse. If you'd like to learn more about beneficiaries, we recommend you registering for our upcoming webinar on beneficiaries, which will be held on April 23rd. So, what are some actions you can take today to make sure that your super is on track? It may be worth considering to consolidate your accounts. But what does this mean? It means having multiple accounts, which may not be uncommon if you've had a range of different jobs. You can search for lost or unclaimed super by the ATO by visiting the MyGov website. From here, you can consolidate it all. There are a few reasons why this may be a good idea. Firstly, if you have accounts with multiple super funds, then you may be paying multiple sets of fees. And so consolidating your funds may help you save money. Having all of your super in one place can also reduce your paperwork and make it easier to track. Additionally, depending on your objectives, it is important to review the performance of all your funds of which you're remembering and consider this as a part of your decision-making process. There may also be reasons to retain multiple super accounts, and consolidation may not be right for you. Before consolidating, make sure you review any insurance or investment arrangements to make an informed decision. And once again, if in doubt, seek advice. Okay, so let's summarize some further actions for you to take. So consider if you need to have duplicate accounts, you may be paying 2 sets of fees and insurances, which no one wants to be doing unless necessary. Now, not all of us know if we have duplicate accounts, but if you've had lots of jobs, you could have lots of accounts. Also, looking to the balance. If you think there isn't as much as you thought you should have, you may have another account. You can also book in for a super health check with us. There's no additional cost to this, and it's open to non-members too. I'll explain shortly how to do this. Make sure you're registered for Member Online. From here, you can manage your super online, update things like death beneficiaries, investment, update details, and also consolidate your accounts there as well. Another action is to consider advice. Today, we've talked about the importance of getting advice several times. Did you know that limited advice is included in your membership, so it's not going to cost you anything extra? As we mentioned earlier, as a boutique fund, you also have the option to book in a 30-minute super health check at no additional cost. This super health check covers a variety of areas, including how to potentially increase your take-home pay through salary sacrifice, how combining multiple superannuation accounts can save you time and money, paying the right insurance premium for your type of occupation, and learning how much you may need to retire comfortably. If you'd like to book now, there is a QR code on the screen. You will also receive a link to book a super health check in the coming days alongside today's webinar recording. So we offer a range of personal advice options suited to individual members' needs. If you're looking for specific information about making contributions or investment strategies, our intra-fund advice team can help. Book in an over-the-phone meeting with a financial advisor at no additional cost. As we discussed earlier, we also provide scaled and comprehensive advice service. This service takes a complete view of your financial situation to tailor advice to suit your individual needs. It's a face-to-face meeting with one of our advice teams in Brisbane or various regions over Queensland. Appointments can also be arranged via digital channels. The cost will depend on the complexity of the advice, and this cost may be deducted from your Brighter Super accumulation account. Two of the most common questions members ask as they approach retirement is, how much super do I need to retire, and do I have enough super? A retirement health check with one of our financial advisors will help you answer these questions. It's never too early to start planning for retirement, so talk to us and find out how we can help. Similar to today's Super 101 webinar, our seminar webpage includes a range of upcoming webinar topics, so please keep an eye on this page as we update it regularly. If you register for any webinars, regardless if you attend, you will receive a copy of the recording the day following the webinar. I've covered a lot of ground today. You can also visit the resources tab for calculators and forms and info sheets for more information on what we have discussed today. On that note, it's over to you now for any questions, and I'll ask James to facilitate our question and answer session. I'll also invite James back to join us on the screen.
Thanks for that, chat. We did have a couple of questions throughout the chat, but answered them all accordingly. But apart from that, no further questions per chat.
Lovely. Thanks for that, James. So thanks again for taking time to come along and attend our webinar. One last question before we bring things to a close. If you could just answer the poll of overall, how satisfied were you with today's webinar? Thank you very much for attending today's webinar. We hope to speak with you soon.